Time now for Options Insight. I'm Abigail Doolittle. Joining me today is Steve Sosnick of Interactive Brokers. Great to have you here, Steve, as always. And, you know, stocks are just sort of fluctuating right around even today, although perhaps going to break a 3-day losing streak. Of course, the G20 coming up. Volatility, where is it for stocks? Seeing a little bit of it on the year, though, for bonds. What do you think about this situation?
Well, you can certainly make an argument that the bonds are having a much more volatile year behind them. I mean, the stock market has, had its ups and downs, but the bond market has been relentless when it's been moving. And you'd expect all sorts of hedging trades because it's a tough situation. If you're a bondholder, do you chase the rally? Do you keep one foot out the door with a hedge? Volatility should be high, and that's what we're seeing.
Well, one place we're not seeing it, though, is for stocks. Although if we go into the Bloomberg and we take a look at the VIX curve, it would appear that it's moving in the right direction. I say this only because we do see that the VIX curve going out into March of 2020 is going in the right direction for volatility or up. But you make the point that it's very low.
Well, it's not very low per se. I mean, we're not seeing like the 10, 12 levels that we saw last year before the big blow up, but we are seeing it in contango. It's very normal. It's a very normal curve. It's a little bit of steepness at the short end, which is to be expected with all the geopolitical stuff that's out there. And, we could spend 20 minutes just running over that. But otherwise, it basically follows an interest rate pattern. And you can see there's always a little financing wackiness around December, which is that little kink you see.
And this is actually pretty similar to what we saw last year. But you think that means that investors missed at least the degree of the fourth quarter sell-off?
Well, the market was blindsided by it. If you looked at if we could pull up the VIX curve from where it was a year ago, it's pretty much identical to what it is today. But then if you look at it 6 months ago, it's this hugely inverted curve at a very high level. That's what happens when you have the blow up. At this point, the volatility curve is predicted. It's not, there's more to it, but effectively it's predicting, let's say, an 18 to 20 VIX out through the fall. And last year it was predicting the same thing, and you had roughly a 30. So it's a decent predictor, but far from perfect. So how do you trade all of this? First of all, lesson number one is it's very dangerous if you're going to be net short volatility. A lot of people, it's a very common trade to spread the volatility, sell the higher priced out longer term VIX future and buy the front. And why is that dangerous? Because if the front expires before you've hedged it, you can leave yourself naked net short. And like the example I gave, if you left yourself net short December VIX last year, you blew up. So what's a better strategy? Better strategy is if you feel the need to short volatility, it's best left to you have to be very disciplined, and you have to have very disciplined and deep pockets, basically. So it's best left to professionals. But you could be selectively selling volatility at spots when the curve inversion or something like that. Those do tend to become contango trades. But that's also that's not the easiest trade to do. I'm sure we'll be talking about this again soon. Yep. Steve Sosnick of Interactive Brokers, thank you for breaking down that VIX curve for us on Options Insight.